Let's talk about practice question 6.2, empirical evidence on UIP part. For the CIP part, I did I solved the practice questions on CIP last week. So this week, this is just about UIP things. So part one, the question 3 and 4 are related to UIP. For example, question 3 says, explain the violations of the UIP based on the model of these three papers. In order to write the answer for these kind of questions, you need to know what is UIP and what is the meaning of the violation of UIP and what is how these models are related to the violations, right? It's basically the summary of the topic 6.2 slide. So I'm going to summarize the key point in 6.2 to explain this one. So before doing that, I'm going to briefly review the topics 2.2 UIP. So we talk about UIP there. So we made these assumptions, default free deposits. So the money market instrument F, money market instrument D, these are default free. It means if you put $1, for example, today, after one period, you're gonna know what you're gonna get at the end of for the one period. So this could be $1+ interest rate. So you know for sure you will get this one, right? We talk about this one in CIP case. So default free and no transaction cost means we don't have to worry about bid-ask spread. And these are important assumptions. Risk neutral investors. Even though investors are taking risk, they don't ask any compensation for that. Given these important assumptions, we can derive UIP for two currency. So what you see here is the risk-free returns by investing into F money market instrument. But you see in the right-hand side, this is the expected return. So this is important things. Expected return from converting currency F into currency D and investing into D money market instrument. After one period, you're gonna convert the D amount back into F using mean forecast of the future exchange rate. Previously in CIF, we had the forward price here, so you can fix the future exchange rate by using forward contract available today. Instead of doing that here, we're gonna use mean forecast, and we're gonna compute expected return from this strategy. Now, because we assume risk neutral investor, this investor will not ask any compensations, which means their expected return is just equal to risk-free rate return. So this is the UIP. And given UIP, we can derive the following relationship. So what this means is, if you see plus here, you mean you see plus here. That means if currency D is bigger than F, that means F should appreciate. So the high interest rate currency D is expect to depreciate. The plus sign here means F appreciate. F has a lower interest rate. So lower interest rate currency should appreciate. Higher interest rate currency should depreciate. That's what UIP said. So for these question 3, you have to first briefly explain what is the meaning of UIP using equation and symbol. So you have to briefly explain what are the assumptions, and then you have to show these expressions as a UIP. Then I want to briefly mention this one. When pound interest rate is bigger than dollar interest rate, what is the dollar character rate? We're gonna borrow with dollar, the lower interest rate currency. So borrow low interest rate currency and invest into high interest rate currency money market, right? So the excess return looks like this. So this is what you're gonna pay after one period. So you are borrowing $1, you have to pay back this amount. So this one, you're gonna convert dollar into pound, that's this part. You're gonna put that pound into pound money market. So you're gonna get the whole thing here after 1 year, and then you need to convert that back into pound. So the expected value will be expected value only appear in front of this one because all other things are just number given time t information set. This is conditional expectations given all time t information set, right? So we talk about this one. And the important thing is, what is the sufficient conditions for profitable dollar carry trade? If high interest rate currency is expect to appreciate, so if pound interest rate, so pound is a high interest rate currency. If that currency is expected to appreciate, then dollar carry trade will be profitable. So this is the direct opposite of the forecast given the UIP. UIP says high interest rate currency should depreciate. Now carry trade says high interest rate currency, if high interest rate currency appreciate, then you're gonna make money by implementing dollar carry trade. So what is the meaning of UIP violations and what is the relationship with that with the carry trade? UIP says high interest rate currency should depreciate. Now, if you test that using regressions, I will explain that in a minute again, then the regression result says high interest rate currency is in fact appreciate. So that's the indication of violation of UIP. Given that profitability of carry trade, we can implement that using portfolio approach to make money. Now, these models are trying to explain why you are making money by doing so, right? So we can connect like that. So what is a UIP? What is the meaning of violations? What is the meaning of that in terms of carry trade? Given carry trade, what are the use of these models, right? So that's what we talked about in the last class. So here, given UIP relationships, high interest rate currency should depreciate. We can run a regression to test it. So we remove expectations and we put intercept and slope and we add error terms. So I explained something like this. So in the regressions, we always trying to get the linear relationship between y variable and x variable. Regressions impose this linear relationship. So A is the intercept, B is the slope. What is the meaning of epsilon t? This linear relationship cannot be true all the time. Sometimes data are here, data are here. So error term epsilon t allows us to get some deviations from this linear relationship, some error. Real data cannot be explained exactly by this linear relationship, so we add an error there. But what is the assumption in the regressions? We put these assumptions. The average value of error is equal to 0. So given these assumptions, we estimate this regression model using historical data of changes in exchange rate, historical data of interest rate differential. We run regressions, we estimate alpha, beta. So once you estimate alpha and beta, if you take expectations on both sides, conditional expectations, this becomes 0. This is equal to left-hand side of UIP. This is similar to the right-hand side of UIP. If only if alpha is equal to 0 and beta is equal to 1, then we get UIP form. So we test UIP using regressions by estimating these two parameters and then take conditional expectations and compare that with the UIP. It turns out this must be true to see the UIP. So we can test the UIP based on this hypothesis. So we can test this one whether this is true or not. Now, empirical evidence says beta is negative. What is the meaning of negative beta? Negative beta means you have negative beta here. Beta is negative. That means if you see negative value here, what is the meaning? The interest rate for F is bigger than interest rate for D. That is the meaning of minus sign here. So if interest rate of F is bigger than interest rate of D, then minus times minus, you get plus here. That means plus here means the currency in the denominator appreciate. For every one F, you need to pay more D in the future. So plus here means F appreciate. So negative beta indicate higher interest rate currency F appreciate. This is the indications of the UIP violations. At the same time, this is the indications of sufficient condition for profitability of carry trade. So based on these regressions, we can test the UIP and also we can think about how to make money. So this is forecasting regressions. Given ranking of interest rate, by implementing carry trade, which means borrow currency D, convert, invest into currency F, money market, because of these sufficient conditions, you will be able to make money, right? Very important, the UIP regressions. So once you know that it's profitable to invest using the carry trade, how do you actually implement that? When you implement certain strategy, you have to use portfolio approach. So in order to do that, we talk about this one in the class. You need to rank all countries except for US according to, for example, 1 month interest rate. So this is for 1 month carry trade. If you use 3 months here, that's a 3 months carry trade strategy. Anyway, here we rank every country in terms of 1 month interest rate, and we form 6 portfolio, CA1 to CA6. So what is the CA1? CA1 is the 10 country with the low interest rate. CA6 is the 10 country with higher interest rate. And for each country, for each portfolio CA, we compute the excess return of the dollar carry trade, which means borrowing dollar, investing into foreign currency money market. Now, you may wonder, carry trade means borrowing low interest rate currency and investing into high interest rate currency. Dollar carry trade doesn't mean the carry trade doesn't mean you have to borrow dollar. Carry trade just means borrow low interest rate currency and invest into high interest rate currency. So you may wonder why by doing this, always borrow dollar and convert invest into foreign money market. What is the relationship with this one and carry trade, right? In the class, I explained using this relationship. So if let's say dollar interest rate is between interest rate for CA1, the 10 country with lowest interest rate, between that and CA6, the 10 country with highest interest rate. This is realistic assumptions. So if you have interest rate data for 60 countries, dollar is going to be in the middle for almost all the time. Then if you borrow dollar and convert and invest into country in the CA6, that's indeed carry trade, dollar carry trade, because you borrow low interest rate currency and convert invest into high interest rate currency, right? So borrowing this one, convert investing into this one is a carry trade. What about this one? If you borrow dollar and convert invest into CA1, that's not carry trade. Carry trade means you have to borrow CA1, the interest rate for CA1, and convert invest into dollar. So this is the reverse carry trade. You borrow the high interest rate currency dollar and convert invest into low interest rate currency. However, we are computing actually zero cost carry trade strategy, which means you're gonna buy portfolio CA6. That means you're gonna carry trade in terms of this pair, but you're gonna short sell CA1, which means you're gonna make profit by short selling this one. So if this one lose, you're gonna get something. So when do you see negative return for this one? That's the carry trade. Carry trade says borrowing this one, converting, investing to this one will give you plus return. What you did is the reverse of that. Borrow with high interest rate currency, convert, invest into low interest rate currency. If you short sell that, that is in fact you are gonna borrow CA1 and invest into dollar. So because of this short selling, you're gonna get profit from this one and also from this one, and both are why you're making money because of the carry trade, the analogy. You reverse carry trade here, so you're gonna short sell it, which means you're gonna actually doing carry trade. Anyway, so this is how we implement carry trade strategy in real practice. You need to do this in portfolio. Now, after you implement carry trade strategies, so zero cost dollar carry trade portfolio, we're gonna express that as the high minus low in FX market. So HML FX is the excess return from implementing zero cost dollar carry trade portfolio. Now, it turns out it's really difficult to explain this one as a risk premium using well-known asset pricing model in equity market. So three other papers said, what should we do about this? So first, Lustig, Lusanov, and Bettelhen says, since we have alpha, let's now use that as a new systematic factor to explain the any risky asset return in FX market. So they propose this model. This is the average excess return from investing into FX market. So you can put any strategy, any currency strategy here. The excess return, average excess return from implementing any currency strategy, the premium, risk premium is equal to sensitivity and times average of the 6 carry trade returns. They interpret this one as the average FX movement, and they add this HML as an additional factor. So what is the significant about this model? This model suggests any profitable investment strategy, the return from implementing that is related to the risk premium of average FX movement and carry trade movement. So this paper is actually summary of they propose as a pricing model based on the profitability of carry trade, and they try to understand all other profitability of all other strategy using these two factors. But this is not that satisfactory. So why HMLs are implementing HML are making profit? What is the economic rationale? So two other papers claim, the first paper claimed volatility risk premium as a reason for getting profitable carry trade. I mentioned it as use the illiquidity premium as a reason for getting profitable carry trade. So this guy proposed this model. So any excess return from implementing not only carry trade, all currency trade, the average return from implementing any currency trade, including carry trade, is equal to average, the risk premium coming from average FX movement plus they proposed to use unexpected volatility increase in global volatility in FX market. So their argument is this. Unexpectedly high volatility is bad news. So why it is important to think about bad news? So when we talk about CAPM, we say something like this. Higher beta means it's risky. And since high beta is risky, you're going to ask a premium for any stock with high beta. So what is the rationale? What is the meaning of high beta? When market goes down, bad times. When market goes down, if your asset has a high beta, that means your asset will give you big negative returns. So high beta intuitively means during the bad time, your asset will give you really low returns. You don't like that. You don't want to hold an asset with big negative returns during the bad times, right? So before investing into that asset, you want to ask a premium. That is the logic of CAPM. So here, we need to know about the bad times. So unexpectedly high volatility is bad time. What is the meaning of that? So today you got a news from the market that from now on there will be huge volatility in the market. So you don't like that, right? Huge volatility is usually not a good news to you unless you buy options. So we're not talking about options here. So we can say that the unexpectedly high volatility is bad news. Then if some asset or some strategy providing you big negative returns during unexpectedly high volatile time or bad times, you don't like that. If some asset and strategy gives you big negative return during this volatile period, you feel it's risky to hold that. So you're gonna ask a premium before investing into that asset. So given this bad time story, investor ask risk premium for an asset with low returns during unexpectedly volatile FX market. And they said this is the important factor. Now, how do we know whether this new factor could explain at least the profitability of carry trade strategy or the profitability of any currency strategy? We're going to use the regressions to test whether this model is able to explain the risk premium from implementing any currency strategy, like in the following way. We're going to collect the historical data of the, in our case, the profitability of carry trade strategy. So based on this portfolio approach, each period we can compute historical return of HML FX. Each month, we can rank all countries depending upon its interest rate, and each month we can get CA1, CA6, and each month we can compute the the return for zero cost dollar carry trade portfolio HML FX. So we have historical data. So we put that in the left-hand side. And then we have the average, the return of CA1, CA6 every month. So we have historical data for RXT. And we need to assume one thing here. This is the return factor. I talk about the factor mimicking portfolio in the lectures, which means whenever there is an increase in FX volatility, let's say we have group of assets giving us exactly same directions, which means, okay, so if there's a 1% increase in FX volatility, let's say a group of asset gives you 1% increase in the return. When there's a 1% decrease in the global volatility, let's say this asset gives you 1% lower returns. What I'm trying to say here is this so-called factor mimicking portfolio give us exactly same changes as this factor. Okay, so given that factor mimicking portfolio, we can get the historical value of that here. So we put the historical value of the carry trade return in the left-hand side. We put the average FX movement, and we put this so-called return factor for the mimicking the movement of FX volatility. Then we're gonna run these regressions and estimate intercept, slope for RXT, slope for the global volatility factors. And if you take expectation on this one, so as I explained a few minutes ago, we always impose these assumptions. Average value of error is equal to 0. Given these assumptions, after estimating intercept and slope, we can take expectations. Once you take expectation, this epsilon term is going to be gone. And we put expectation here, right? Now, if alpha CA is equal to 0, then what is the meaning of that? The meaning of that, so if this is gone, that means average excess return from implementing carry trade is exactly the risk premium from taking this one and this one, which is our model here. If alpha is equal to 0, we recover our model. Any excess return from implementing currency strategy, that return is coming from this part and this part. Risk premium related to average FX movement and risk premium related to global volatility movement. So alpha is equal to 0, then we're going to say that the profitability of carry trade strategy is explained by this factor. Indeed, they find alpha is equal to 0 in these regressions, and they claim that we have find the economic reason behind this profitability of carry trade strategy. They said carry trade is risky. Why it's risky? Because you will lose a lot during times of FX market volatility. When you implement carry trade, you're gonna lose during this period. And this is bad time. You don't want to hold an asset with big negative returns during this bad time. So before implementing carry trade, you're gonna ask a premium for that. Okay, so that's our usual interpretations. Now, Manchin et al., they propose slightly different model. So any excess return from implementing currency strategy is equal to something related to average market movement, and something related to the global illiquidity in FX market. Their idea is almost similar to this one, but instead of using volatility, they use illiquidity. In their model, they said unexpectedly high illiquidity is bad news. So there's a sudden news in the market says from now on, it's not easy to buy and sell all assets in the market. So if you have invested in certain asset, after hearing this news, you learn that it's not easy to sell your asset to them in the market. That's not a good news. You don't want to buy certain asset with this kind of news, right? So this is bad news to investor. So investor will ask premium for asset with low returns during this unexpectedly illiquid market. Why you ask premium? Because during the bad time, this asset gives you lower returns. You don't want to hold such an asset, giving you negative returns during bad time. So this paper and this paper are almost same in terms of structure, in terms of explanations. Only difference is here you use volatility as a something generating bad news. Here, use illiquidity as something generating bad news. Other than that, how do we know whether these models are able to explain the profitability of carry trade? Just like before, we put historical value of the carry trade portfolio strategy, HMLFX, in the left-hand side. We put RXT and some factor mimicking return on the global illiquidity factor in the right-hand side as a data. And we impose these assumptions, the usual assumption for regressions. Given this historical data, you estimate these regressions using some statistical method, least squares, and you estimate intercept, slope for RXT, slope for illiquidity factors. Once you take expectations, this error term will be gone, and we have expectation here, expectation here, expectation here. If the intercept is equal to 0, then we recover our model, which means any excess return from implementing currency strategy, including carry trade, explained by these two risk factors. Indeed, they find that this is equal to 0, which means the profitability of carry trade strategy is explained by their riskiness related to this global illiquidity situations. In words, carry trade perform poorly. So carry trade generate negative return during times of high illiquid FX market. So during bad time, carry trade giving you negative returns, so you feel it's risky to invest into carry trade. So before investing into carry trade, you're gonna ask a premium, right? So this paper says high return on carry trade is the compensation for taking volatility risk. This paper says higher returns on carry trade is the compensation for taking illiquidity risk. Now, given this summary, now you can write an answer for this one, right? You start with the UIP, clearly explain UIP with symbol and equations, and then you're gonna explain violation of UIP using the regressions. And then given that regression, we know that the profitability of carry trade strategy. So you're gonna talk about how to implement that using portfolio approach. And then given the portfolio approach, you're gonna talk about these three models. So when you explain this kind of thing, you have to use equation and regressions and define everything precisely, just like what I just did in this review slide. And the next one is actually very important. This one, part two questions. This is kind of question similar to what you expect to see in the actual exam. So let's talk about this one given our summary. Let's say a quant in your company have developed a new zero cost investment strategy. So buy certain portfolio and sell certain portfolio, right? Just like the HML FX. So using different criteria. So this guy used a different criteria, not interest rate based ranking, use different ranking and talk about and implement the zero cost strategy. So advanced statistical model with a good story, and would like to claim its potential to you. So you are the head of the active investment. You need to decide whether you want to invest into this strategy, whether this is a new strategy or not. Let's suppose you use this Banco et al. Model as a benchmark model for some reason. How do you know whether this new zero cost investment strategy is a really new and is this new strategy is profitable? How do you know that, right? A sketch of answers. This looks almost same as the review slide I just mentioned, and also we talk about very similar things when I explain the topic 5 practice questions. Anyway, so benchmark here is this one. Any excess return from implementing currency strategy, the plus, if you get plus return, that's the risk premium related to the average FX movement and the global volatility. So how do we know whether this new zero cost investment strategy is profitable in terms of this model? You're gonna run the regression. So first, you're gonna get the historical value of this investment strategy. So you have to compute something like high minus low new criterion. So you want to implement this zero cost investment strategy first by ranking all country in terms of certain statistical criteria, statistical model, and you're gonna buy the highest one and you're gonna show sell the lowest one. You're gonna get historical value of this one. And you put that in the left-hand side, excess return. And then you collect RXT, this return mimicking factor for global volatility, and you're gonna run regressions. Once you run this regression, you're gonna estimate alpha, delta, lambda. Once you estimate that, then you can take expectations. So if you take expectation, this will be gone. Then that will be almost same as the model used here. See here, the benchmark model. Only difference is the alpha. Let's say we find alpha is equal to 0. What is the meaning of that? Meaning of that is the profitability of implementing this new zero cost investment strategy. The profitability is coming from, when alpha is equal to 0, is coming from one of these two, which means we already know these two. If alpha is equal to 0, that means this strategy is not new and there is no extra return from implementing this strategy. We already know these two factors, and there's nothing new about this strategy. So there's no extra return for this strategy. The strategy seems just a combination of well-known average FX movement and global volatility movement. For simplicity, let's assume we find delta is equal to 0, so this is gone, and lambda is equal to 1. Then, and this one is equal to 6%, which means the average excess return from implementing this strategy is positive. Why? Alpha is equal to 0, so no extra return. This part is 0, so no return from taking a risk in terms of average FX movement. Everything is coming from here. Now, this one is closely related to carry trade. The previous Manco model says HMLFX, the carry trade strategy profitability, is explained by this factor. So in this case, so we got plus number here, 0 here, 0 here, only numbers here. That means this so-called new investment strategy is just carry trade strategy, nothing new. So there's no reason to implement this new investment strategy. You can just buy an ETF on carry trade if you want. Let's say we find alpha is equal to 10%. What is the meaning of that? Then indeed, some of the return from implementing this currency strategy, something is new. You earn new returns, additional returns, which cannot be explained by the usual factor, well-known factor in the market. Then we can implement this strategy. Now, I need to put this note here. The important thing about this question is why you are using this model as a benchmark model. Is there any reason for that? I talk about almost same thing in topic 5. The answer, once you decide which model is going to be a benchmark model, after that, all the process are going to be almost exactly same. You collect the historical data, you run the regressions, you test on the intercept, right? The procedure is almost same. However, the important thing is what is the good benchmark asset pricing model? So if I ask this kind of question in the actual exam, you have to pay some attention on this part. For example, for these questions, let's say I delete this one. I delete this sentence and just ask the same question. Then you have to write your answer by writing down this part. What could be a good benchmark? Then you have to write down several model. You learn in the class, the Manco model or Mancini model, or it could be a combination of two factor. So it could be three-factor model, average movement in the FX market and volatility movement and also illiquidity movement, right? You could have three-factor model. So you have to spend some time to explain that. And based on that model, you have to explain the regressions. You have to talk about alpha and the meaning of alpha, right? And the last question is trying to is asking you to summarize this Bronnemeyer paper. I posted a video clip on Blackboard, so I'm not going to talk about this one in this Friday's lectures because I want to focus on the revisions, what I expect from you in your answer on the short questions, and I will demonstrate how to take the mock exam and actual exam. So because there are some confusion about the exam format, I need to explain that clearly. So I don't have much time. Therefore, I just posted a video clip on this one. The important thing about this paper is you don't need risk premium story to explain the profitability of carry trade. There are UIP violations, but it may not be related to risk premiums. What is the meaning of that? I will just briefly provide you an overview about this paper. The summary is here. This is a theory paper. So they assume risk neutral investors. by definition, there will be no risk premium. So they are able to generate the profitability of carry trade even with these assumptions. That's very important. Previous papers, we all interpret the profitability of carry trade as a risk premium, which means investors are not risk neutral, right? Here in this paper, they assume risk neutral investors, but they allow short-term frictions. So what is the frictions they are talking about? So I use the example in the lecture slide. This is the summary of lecture slide. So once you watch that video clips, if you understand the summary, you're gonna be fine. By the way, I want to make a note on this. In the real life, we don't have one clear answer for this kind of things. I think the combinations of risk premium and market frictions could be the reasons why we have some profitable the currency strategy in the real practice. So there are some role of the premium, risk premium, and also there are some other roles played by this friction story. Anyway, let's suppose the pound interest rate and dollar interest rate is same. So this is a theoretical model. This is a story we're gonna tell. They are going to tell. Bank of England suddenly increased its interest rate. So now pound interest rate is bigger than dollar interest rate. Given this news, speculator will conduct dollar carry trade. So borrow dollar, convert, invest into pound. They do this one for some reason. The problem is these speculators are highly leveraged ones. So this is the true in real practice. So we find many investors, many speculators in the FX market, and it turns out they are highly leveraged, which means they don't have much capital in their balance sheet. So let's say they have only $100 in their bank account, but when they make positions, they have positions for like a $10,000. That's leverage. You have only $100 in your capital, but you're gonna do margin trade. This is so-called margin trade. You bet on huge trading of the positions based on small capital. So huge leverage, right? So this speculator with huge leveraged balance sheet will conduct dollar carry trade, but they're gonna limit the size of their trade. So which means you can implement carry trade with $1 or $1,000 or $10,000, right? But because they are highly leveraged, they cannot implement carry trade with uh given like a $10,000. They're gonna limit their investment up to the smaller amount. They're gonna worry about limited borrowing capacity. They cannot borrow big money, and they need to worry about negative skewness of carry trade. What is the meaning of negative skewness? So if you watch the video clip, you will find out this slide. We can compute the profit of carry trade, and we can get the histogram of that. Negative skewness means something like this. If you implement carry trade, we have huge possibility of big loss after one period. Big negative skewness means this. So there's a crash risk involving with carry trade. These speculators, they limit the size of the carry trade strategy because of they worry about this big carry trade loss. They also cannot borrow sufficiently to implement carry trade. So I need to explain one more thing here. So I didn't do this. In real practice, in the textbook, how do you implement carry trade, dollar carry trade? So borrow dollar, convert, invest into pound, right? The one example of dollar pound case. Here, you need to borrow dollar. That means if you cannot borrow huge amount of dollar, you cannot implement dollar carry trade strategy sufficiently. So with borrowing restrictions, you cannot implement carry trade with big number. Number two, you can also buy high interest rate currency forward, pound forward. Even when you implement carry trade like this, in real practice, you need to put some collateral. When you borrow dollar, also you need to put some collateral. This is the market friction. In the textbook, we just say borrow dollar, convert, invest into pound. Here, we just say you buy high interest rate currency forward. That's a textbook. In the real practice, when you borrow something, you have to put collateral. When you even do when you buy high interest rate currency forward, you have to put collateral. So this is the market frictions. Given this collateral, we cannot implement carry trade fully. Therefore, the idea is speculators conduct initially small amount of dollar carry trade. So let's say we are at T, they want to implement something like $10,000 carry trade, but they couldn't implement this. So they only implement $1,000 carry trade at time T. And then at time T plus one, they're gonna implement another $1,000 carry trade. What I'm trying to say is they initially have an intention to implement $10,000 carry trade, but they cannot implement whole amount at time T. They're gonna just implement carry trade gradually at each time. Time T, small number, T plus one, small number, T plus two, small number. So even though we implement carry trade here, so we observe interest rate ranking here, actual carry trade will be executed at time T a little bit, T plus one little bit, T plus two little bit. The problem with this one, what you are doing here, still borrow dollar, convert invest into pound. Here, borrow dollar, convert invest into pound. So each and every period, you're gonna do this one. Gradually execute dollar carry trade strategy. Then what is going to happen? At T plus one, borrow dollar, convert invest into pound. That means pound appreciation. Borrow dollar, convert into pound, always more demand for pound. So pound appreciation at T plus one, pound appreciation at T plus two, pound appreciation at T plus three. So at time T, you have reason to do dollar carry trade. Pound interest rate is high. But you're gonna implement carry trades little bit at time T, little bit at T plus one, little bit at T plus two, little bit at T plus three. And each time when you implement carry trade, you wanna borrow dollar, convert invest into pound. You wanna borrow dollar, convert invest into pound. You wanna borrow dollar, convert invest into pound. Each and every period, higher demand pound will be there. So pound will appreciate, pound will appreciate, pound will appreciate. So in summary, at time T, pound interest rate is higher than dollar interest rate. After one period, pound appreciate. High interest rate currency appreciate, appreciate, appreciate. This is the profitability of carry trade. So carry trade says if higher interest rate currencies appreciate in the future, you're gonna make profit, right? That's how Bruno et al. Explain the profitability of carry trade, even though we assume risk neutral investor. So this is not risk premium. Why is profitable? Because of market friction, because of you cannot implement full size carry trade strategy at time T. You're gonna slowly implement that each time. Now, this cannot go forever. Why this cannot go forever? Because we assume risk neutral investor, which means UIP should hold eventually. By definitions, UIP should hold when we assume risk neutral investor. So there should be huge collapse of pound in the future. So when we observe pound interest rate is bigger than dollar interest rate, pound will appreciate every period. But in the event, eventually, this is theoretical model. Eventually, because UIP should hold, there should be massive depreciation of pound, crash of pound. So why this is happening? They okay, so the problem is, let's say you're a smart investor. You know every story. You know that because of market frictions, pound appreciate, so it's profitable to do carry trade strategy. So smart investor, you wanna implement carry trade strategy along with all other market participants. But you know that sometime in the future, pound will depreciate. Then you should bet on pound depreciations because you're smart. But when do you need to bet on that? Even though you are smart, you know that pound will depreciate in the future. If everyone else is conducting dollar carry trade, you cannot go against the market movement. This is so-called limit to arbitrage. Even though you are smart, if everyone else is stupid, there's no reason to do the opposite things. You just need to go along with the market. You cannot win against the market movement. The problem is one day there should be big negative movement in the pound. They explain that moment using the so-called liquidity spiral. Well, I think this is too much to explain here, so just please watch the video clip. When they said when there's a big increase in peaks, peaks is the indicator of market fear. Some bad news happen in the market, then if sufficiently big negative news happen in the market, that will trigger something bad in the market. So-called going the spiral means the two things move together. So one thing makes the other things going down, that the other things make one thing go. So there are two things. Peaks increase, this will go down. They will trigger, this will go down. But going down of this one will trigger again going down of this one. So they keep going down until the market crash. That's the so-called liquidity spiral. What is it? These two things. One thing is the funding liquidity. The other thing is the market liquidity. Funding liquidity means when you make business, you have to borrow money from bank. Funding liquidity means how easy you can borrow money from the banks. So lower funding liquidity means it's not that easy anymore to borrow money from bank. You're gonna get margin call from your bank. Bank says you have to pay back your debt. And what is the meaning of market liquidity? Market liquidity means it's easy to borrow, easy to buy and sell certain asset. That's the good market liquidity, high market liquidity, right? These two liquidity will cause each other to decline until the whole market collapse. So take a look at the slide and watch the video clip to understand these logics, why this is happening. This is also related to the collateral. Anyway, so this is the end of the today's sessions. Do you have any questions? What sort of reason could we give for choosing a benchmark? So let's say the currency strategy you see is very volatile. You think huge volatility during the bad times, during the high volatility period, your currency strategy could give you big negative return. That means your strategy is exposed to that risk. That means you want to use volatility factor. Well, if you are not sure, you can use most comprehensive model. What I mean by most comprehensive model, you can include volatility factor or liquidity factor both in your benchmark model. And you're gonna say, the profitability of a certain strategy are coming from either volatility risk or illiquidity risk, right? And you can think about alpha in terms of that model. So what I'm trying to say here is when you think about the profitability of a strategy, you have some reason to believe that strategy has certain characteristic. What I mean by certain characteristic, during the bad time, your strategy could be exposed to that risk. If you suspect about that, if you have reasonable reason to say that your strategy is, for example, related to the volatility of the market, then you can use Menko model. But if you are now not sure, then one thing you can do is you use the most well-known the extended model with all well-known factors. Your strategy could be related to liquidity or volatility or together, right? Is that answering your questions? Okay. Actually, you can use the same logic in the equity market case, topic 5.